All right. Today is Wednesday, November 16. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's start by how the events unfolded today. Yesterday, we were on the brink of World War III. And of course, the market reacted negatively. Not by a lot, but it went down. And it's all about this missile that struck Poland. And of course, now we know that it was a Ukrainian missile. Ta-da! And it appears that Ukrainian clown Zelensky was about to drag us into World War III. But mission failed. Yet the bigger mission was accomplished, which is another, $40 billion now? Which is going to go up to 50 and then 60 billion, and you know the deal. It keeps going higher and higher and higher. The biggest money laundering scheme in history. And of course, who predicted all of this yesterday? Yep, the guy you're listening to right now. And of course, the sheepies and the robots attacked me yesterday, and now they're proving that they're wrong, and I'm right again. Any apology, admission, hey, I got it wrong, you got it right, my bad? No. Because it's all about ego, it's all about stupidity, and you know the deal. And then we got the news from the UK that inflation hits 41-year high, 11.1%. Peak inflation, you say. And that, of course, added a little bit of pressure on the equities market. Now, the bear market rally continues to hold, but it got a lot shakier today. Is that even a word? Shakier? I don't know, but you know what I mean. Because one of the Fed zombies from San Francisco came out in an interview, and remember, she started this whole pivot stupidity. We're talking about Mary Daly from the San Francisco Fed. And Jerome Powell came out and said, look, you guys want 50 in December? Let's do 50. No problem. But the ultimate rate is going higher. So does that even matter? But according to the robots and the zombies behind this bear market rally, the Fed is going to pivot. We're not talking about 50 basis points. We're talking about pausing interest rate hikes. You know, the good professor from Wharton, Jeremy Siegel, comes out and says, yeah, this is the time to pause. And if you're taking classes at Wharton from the good professor right now, I feel really sorry for you. The guy needs to be schooled because the moment the Fed pauses, we're going to get inflation as high as the UK. So watch out for that. But Mary Daly came out today and said, hey, I don't know what you people are doing, but pausing is off the table right now. Take a look.
Well, pausing is off the table right now. It's not even part of the discussion. I'd say right now the discussion is rightly in slowing the pace and putting the pace discussion in the background, focusing our attention really on what is the level of interest rates that will end up being sufficiently restrictive.
And of course, another important event that unfolded last night is he's back. Yep, former President Donald Trump announces a White House bid for 2024. And of course, this was highly anticipated. We knew it's going to happen. A lot of you said, hey, should we buy calls on the DWAC to whack the quack? And I said, forget about it. That trade was, I believe, before the elections, when Dwack the Quack shot up higher by about 60% in a single day. Those call options scored gains of over 10,000%. But I told you the strategy this time around is selling call credit spreads because the premiums are highly elevated. We have the buy the rumor, sell the news phenomenon. And guess what happened today? Give us a live shot for Dwack the Quack, and here it is. Ooh, down over 16% throughout the day and down yet another 2% after hours. Goodbye. Now, folks, we got another important thing to talk about because we're giving you updates on the kabooming economy by the day. And oh boy, we got yet another massive warning here, this time around from Target. So let's talk about it, and here it is. In focus tonight. Target on fire. What are we talking about here? Today, the company Target reported earnings in the morning, and it was an abysmal report. Matter of fact, give us a live shot for Target, the ticker TJT, and here it is, and down about 13% for the day. And a major contributor to the abysmal report by Target was organized crime. And no, we're not talking about the old school organized crime. You know, when it was fun with the suits and ties and you hijack Lufthansa. No. We're talking about the kind of organized crime you're doing this. I'm not doing it. But you walk in the store, you grab whatever you want and you skip the cashier, right? And this cost Target about $400 million. And when it rains, it pours. Yesterday, there was a mass stabbing in Target in downtown LA. Take a look.
Shoppers were the victims of an unprovoked attack, according to LAPD. 2 people were stabbed and another person shot in a California Target store. The Los Angeles Police Department says they were called to a Target in downtown LA around 6:20 p.m. Inside, they found 2 people with stab wounds. One of the victims was a 9-year-old boy who had been stabbed in the shoulder. The other victim was a 25-year-old woman. The LA police chief says she was brutally stabbed in the chest.
So now we're finally realizing that crime is an economic problem here. It adds to inflation because all of these stores have to either jack up the prices because they have to hire more security, and they're going to pass that extra cost to you and me, the consumer. And of course, the majority of these crimes are happening in California, where it's becoming a lawless state. The criminal has more right than the average citizen. But the good news is this is what people voted for. Was it last Tuesday or Wednesday or last Thursday? Right? It was last Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday. Elections week, everybody. But this massive wave of crime in the state of California is courtesy of our beloved governor, Kim Jong-un Newsom, aka California Psycho, who says if you walk to the store and you steal under $900 worth of stuff, that's a misdemeanor. We're not gonna do anything about it. If you steal over $900, we'll book you in, take a picture, give you a slap in the wrist, and you'll be out on your way. Nothing happened. And this is costing corporate America, at least in the case of Target, over $400 million. And we are paying the price for that. And I know what you're going to say. You're going to say, well, but the other side is not better, Maverick. What are you talking about? This is the same thing. You know, I went to dinner a few days ago with my wife and her friend, and they were complaining about how life is getting really miserable in California. Even though you have a salary of 6 figures, you're living paycheck to paycheck. You get to your 40s, and you cannot afford a home in California. And I'm listening to this, and I'm like, yeah, but you guys voted for the same thing all over again, right? You voted for Kim Jong-un. So what are you complaining about? And they say, but what are you saying? Should we vote for Republicans? They hate women. And I'm like, no, you don't have to vote for Republicans. Just do something for the love of God to show that you're mad. Do what I did. I brought in Hulk Hogan as my choice for governor. Let's fix Social Security, brother. And by the way, this wave of crime is going to get a lot better. It's going to be the gift that keeps on giving. Because the economy is heading into a recession. What do you think happens when the economy heads into a recession? It's the Wild West. But back to Target, and Target woes don't stop at organized crime. There was an interesting phenomenon that they revealed today. And honestly, this was not a surprise to any of us because we covered earnings from Target, what was it, a few quarters ago? And they said the same thing. But now they're saying, wait a minute here, the outlook is going to be really, really bad. All of this holidays, spending optimism, not going to happen. We're seeing severe weakness in consumer spending. Matter of fact, Target is now projecting its first decline in comparable sales in 5 years. It's a booming economy, isn't it? And listen to this. Target CEO came out and said in the latter weeks of the quarter, sales and profits trends softened meaningfully, with guests' shopping behavior increasingly impacted by inflation, rising interest rates, and economic uncertainty. And we all remember last quarter when Target CEO was live on CNBC as his stock was crashing, live on air, and he was sweating bullets. Take a look.
What happened?
Well, first of all, Becky, I appreciate being here during a difficult report. Right. But it's a chance to talk about kind of our business and where things stand. And I frame it by really looking at kind of the front of the house of our business and then the back of the house. And if I think about the front of the house, the consumer guest-facing component, you know, we saw really strong comps, over 3%.
Bruh. And I know what you're going to say. You're going to say, Maverick, this channel is all about the FUD. You're just scaring people away. Look, Target has its own problems. But did you look at retail sales this morning? We got information about retail sales. And the consumer is strong and powerful and continues to spend. What are you talking about? And this is, of course, in reference to U.S. retail sales posting the biggest increase in 8 months in October. And these geniuses in Bloomberg, they say, indicating demand for goods is broadly holding up despite decades of high inflation and a worsening economic outlook. You geniuses. The most deceiving piece of macro data is retail sales. You know why? Because they measure retail sales by the dollar amount spent. Now, we have inflation, so yes, the number will go higher, duh. But that doesn't mean that we're buying more. That doesn't mean that the consumer is healthy. It means that we're paying more. For example, the biggest contributor to retail sales moving higher, gas stations and motor vehicle parts. So we're spending more gas station. We're not buying more gas all of a sudden. We're paying more. You geniuses. And of course, when it comes to motor vehicle parts, all of these folks who spend way over the book, buying the most garbage used cars on Carvana, right? And now they're realizing that they got a bad lemon and they have to spend on repairing and fixing this trash vehicle that they bought and spend an arm and a leg for. And oh, by the way, have you been to the grocery store as of late? We're paying more for everything. Retail sales for grocery stores were up nearly 8% in October. So the headline reading is deceiving. It shows that the consumer is spending more. Retail spending is pretty good and healthy. But the devil is always in the details. For example, you're excited about Thanksgiving, my favorite holiday of the year? Well, this turkey you're about to eat is going to cost you a lot more. Peak inflation, right? We're not talking about the good turkey either. This is the Chinese turkey. You eat it and you die right away. And another contributor to retail sales moving higher is my beloved state of California. And of course, we know that Governor Kim Jong-un is spending like crazy and handing out stimmies all over the place to win the votes. And of course, this contributed to a massive boost in retail spending in October. Even I got a check from the government of California. So everybody got checks, $800, $1,000, $1,500, $2,000. What are you going to do with this money? Going to spend and create more inflation. But we have to put the news from Target in perspective when we talk about the consumer. What are the stages of consumer spending? It started with stimmies all over the place, trillion here, trillion there, and people were spending like crazy, buying stuff they need, but mostly stuff they don't need, getting mortgages they cannot really afford, getting car loans they cannot really afford. What happens when stimmies are over? Well, they're not over here in California, but they're about to. When stimmies are over and you exhausted all of your stimmy stash, you move on to your savings stash. Well, guess what? Savings already collapsed. So the consumer is already done with the stimmies, done with savings, and now they're stuck. They got auto loans they cannot really afford, and we're seeing delinquencies like we've seen in the housing crisis back in 2007, 2008. People are paying $1,000 plus in car payments. Insane. Absolute insanity. And oh, by the way, how about your student loans? Remember Joey B told you he's going to forgive your student loans? Well, that's not going to happen. And now you got folks stuck with these massive student loan payments that they cannot really afford, and they're going to go default without forgiveness. The forgiveness It's not going to happen. It was just a way to get you to the voting booth. But again, now you're done with the stimmies, you're done with the savings, you're stuck with all of these payments that you cannot really afford, and you're shitting your pants because what happens if you lose your job? Here comes step number 3, the most dangerous step of them all. Swiping those credit cards up and down, up and down, up and down. And look at this, U.S. household debt jumps the most since 2008, even as credit card rates surge. Whoops. This is a disaster in the making. Look at this. Record high credit card balances in this country as interest rates continue to move higher. This is a recipe for an epic disaster that's about to hit the economy. And look, you put it all together. And I'm using a Pokemon analogy to make it easier for you. The 3 stages of inflation. Inflation begins as pretty good for everybody. Your wages go higher, corporations are making more money, but at some point it becomes ugly as the rate of inflation in wages lags the rate of inflation in prices around you. And while inflation continues to rise higher, the spending power by the consumer starts to diminish. And hence we get into stagflation, where inflation sticks at a higher level, but the pace of economic activity starts to collapse. And this is exactly what we're seeing right now in the economy. And the last stage in the evolution of inflation is a recession, because at some point the consumer can no longer take it anymore. They have no reserves left to spend anymore, and that absolutely annihilates the pace of economic activity and spending in the economy. When the demand disappears for businesses, what do you think they'll do? They're going to get rid of employees. Mass layoffs. And oh, by the way, the Fed raising interest rates right now to tame inflation. That also adds to more and more pressure for companies to initiate mass layoffs to fix their margins, because their expenses are moving higher now, yet their revenues are moving down. So they have to rebalance this by reducing their expenses, and hence the economy dips into a recession. So when folks say, oh, this is peak inflation, good news, the Fed is about to ease, what the are you talking about? Inflation is only cooling down for the wrong reasons. You better hope that inflation is going to go higher, not lower, because if it's going down for the wrong reason, and that reason is the recession. Enjoy. And with that out of the way, let's move on to the coverage of the stock market, and we begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 39.09 points, or a decline of 0.12%. The Nasdaq down by 174.75 points, or a decline of 1.54%. The S&P down by 32.94 points, or a decline of 0.83%. And here are the sectors' performances today, leading the pack at number 1. And number 2 and number 3, capturing the gold, the silver, and the bronze, utilities. The rest all in the red, led by technology, energy, and cyclicals. A recessionary theme today. The ultra-defensives and utilities leading, and the risk-on in tech, energy, cyclicals down. What about the advance to decline ratios? The NYSE 24% advancing versus 75% declining. The Nasdaq 25% advancing versus 71% declining. On to commodities. The dollar was initially down, then it went up again, and then it went down again by the end of the day. But it seems that the dollar is finding some footing here. And if the dollar is about to find some footing, it's going to be bad for commodities. And by the way, I have a warning for energy investors. Watch the heat map analysis, but I'm going to go over it again in the charts analysis. When we look at energy commodities, they're down, crude down, be it the WTI or Brent. WTI down almost 2%, Brent down almost 1.25%, gasoline, RBOB, heating oil all down by almost half a percentage point. Yet the party boy, natural gas, scoring gains of almost 3% for the day. And look at this. We have conflicting information here. OPEC says that the demand for oil is going to go down. And this is, of course, their way of saying we're going to cut supply. But the IEA and the EIA say that demand is going to move higher. In other words, maybe this means the WTI is going to start to outperform Brent. And of course, we got news in the morning that an oil tanker in the Gulf, I believe it was an Israeli tanker, but it was bombed or struck by a drone from Iran. Maybe we should buy call options on these Iranian drones. A lot of success as of late, but the moral of the story is this was supposed to push crude oil prices higher, but it didn't. And this is a sign of, once again, relative weakness, a warning sign. We'll talk in the heat map analysis. But back to the futures, look at this. When it comes to softs, muted across the board, with OJ leading the gains with about 2.5% for the day. And once again, coffee futures continue to collapse. Good news for coffee enthusiasts, but not a good piece of news for coffee sellers or investors. Coffee futures down almost 7% today alone. When it comes to metals, muted across the board, with copper being the notable mover here to the downside, losing about 1.5% for the day. Again, yet another indicator that perhaps the dollar is about to rebound. And then we have meats. We have muted reactions for feeder cattle and lead hogs futures, be it in the green, yet the gainer of the day was live cattle, scoring gains of about 2% today. When it comes to grains, down across the board, and the notable declines were led by soybean oil, down almost 4% for the day, and then we have soybeans also down almost 2%, wheat down almost 1.5%, so is canola, and then more muted reactions, be it in the red for oats, rough rice, corn, and soybean meal futures. On to the big casino, the options market. What's going on here? The hottest table by far, Tesla, the souffle, at around 1.7 million contracts traded today. Look at this. About 52.5% of those were puts. Folks are back buying puts, not calls. Another sign that this rally is about to stall, if not end. Still too premature to assume any of that because you could eat a pie in the face right away. But we have to wait till we get a confirmation we're getting really, really close. At number 2, Amazon, and this is a name that should be in the top of your list if you're going to bet to the downside. We got the warning from Target, you know the deal. And today, the name traded around 1.5 million contracts. About 60% of those were puts, not calls. And Apple at number 3, with around 800,000 contracts traded today. Once again, puts outweighing calls at around 53.5%. On to the unusual activities that took place in the options market today. We start with the ticker OIH. This is the Oil Services ETF. And pay attention now. This is a massive, massive trade. It's going to move the market one way or the other because of the mechanics alone. What am I talking about? Somebody sees the OIH, meaning oil, going down big, and they bought the 285 puts for the expiration date, January 20, with expectations that the OIH could move down and lose more than 9% of its value by then. They paid around $13 and 70 cents apiece to enter this trade, all in all spending around $22 million. Now, why do I say that we're going to see pressure on oil based on this trade alone? See, what happens is when somebody initiates such a large trade in a single day, it catches the dealer by surprise. And the dealer, the market maker, now has to hedge. So if somebody sees the OIH moving down big and they're willing to bet $22 million on that, the market maker has to dump shares. And this hedging initiates a phenomenon called a reverse gamma squeeze. So what is the strategy here for oil investors? If you own these names, and I don't care, be it oil, be it gas, be it oil services, doesn't matter. Sell upside calls and then use this money to finance buying puts. Puts would be your hedge, your insurance policy. Indeed, if oil goes down big. If it does it, no harm done. You're sleeping better at night, knowing that you're not going to wake up someday and your investment goes down 5, 6, 7, 8% in a single day. So again, sell upside calls, use this money to finance buying puts. This is the strategy for now. I'm going to talk about it again in the heat map and the charts analysis. But what about the ticker TCOM? This is for a company called Trip.com. Believe it or not, this company, this stock, is outperforming year to date. It is trading positive year to date. Not a lot of stocks in the market right now can say that, but somebody sees more upside coming for the name, and they bought the 35 calls for the expiration date, December 16, with expectations that the name could blast higher and score gains worth more than 22% by then. They paid around 75 cents a piece to enter this trade, all in all spending around $1 million. And then what about the put spread for KSS? This is for calls. We got the bad news from Target. We got bad news from Macy's. Now somebody sees bad news coming for calls, and they bought the 27.5 puts. They sold the 25 puts, all for the expiration date, December 16. And the expectations here that calls might go down by more than 8% by the expiration date, but not more than 16%. They paid around $1.50 a piece for entering the 27.5 puts, and they received in credit about 80 cents a piece from selling the 25 puts. All in all, the entry cost is reduced to about 70 cents a piece, and that brings the total to about $1 million. On to the heat map analysis. What's going on here? A sea of red for the most part. What's really scary is today the market reacted as if there is a recession scare. They dumped anything cyclical. They dumped anything that is risk on, be it technology, be it chips. Of course, we got the warning from Micron too, but this is old news. We already knew that ahead of time. We knew that the chips are facing oversupply and lack of demand. So chips were down, but when Target warns, Target goes down, the cyclicals go down, travel goes down, leisure, hospitality goes down big. Carnival Cruises went down big after earnings. They're issuing about $1 billion in debt financing. Even oil, another risk on, another cyclical down big. Metals down big. What's working today? The ultra defensive names. We're talking about utilities. We're talking about the healthcare names. We're talking about the consumer staples. We're talking about McDonald's. Not a good look for the market here. And look, today I admitted that I'm overweight oil and I need to reduce my exposure a little bit. Get it down to 3 names. That could be, let's say, an oil name such as Oxy, and then a natural gas name such as EQT. Forget about Coterra because Jim Cramer gave it the kiss of death. Take a look.
Here. Finally, there's a company called Coterra, which is created by the combination of Cabot Oil and Gas and Cimarex, both low-cost operators. Cabot had a strong position in natural gas, while Cimarex was a premier Permian Basin and Anadarko producer. The stock yields an astounding 9.7% here. Coterra is also committed to buying back a huge percentage of shares. Between the dividend and the buyback, they're pouring in 74% of the cash flow. Wow!
And immediately, Coterra is down, at least today alone, over 4%. So again, I'm going to stick to another name besides Coterra, and then maybe an oil services name, be it Valero, be it Schlumberger. I haven't decided yet. But I'm reducing my exposure here, and I'm selling upside calls on the names that I own, and I'm using this money to finance buying puts. Because if the market continues to react in this recessionary mood, we will see oil going down, no doubt about it. What am I adding exposure to? Healthcare and the consumer defensives. The dips in names such as Mondelez, Kellogg, General Mills, Kraft, these kind of names. But I'm not going crazy either, because if the market crashes because we have a recession fear, they will go down too. But so far, until that happens, they will continue to outperform. When we talk about corporate news, how about Twitter? And of course, Elon Musk is pulling all-nighters in Twitter HQ. And people say he's a hard worker. I say maybe he's banging somebody in Twitter, to repopulate the planet. So let's wait until we get the new baby mama. But here's the heat map analysis for the ETFs, red across the board. But again, the recessionary theme, you can smell it, you can see it. For example, today the XLU for utilities moved higher, outperforming the market. What else? The TLT, bonds. Why are folks buying bonds all of a sudden? Defensive. running for safety. The TLT was an outperformer today. But then you have the risk-on cyclicals such as oil, XOP, XLE down, chips, SMH down. Even the Chinese names were down in internationals. That's another risk-on. Biotech, XBI, another risk-on was down almost 3%. XRT, another risk-on, down big, materials down. A new question now becomes, hey Maverick, will this be the theme from now on? The recession theme by McDonald's, by tobacco, by the ultra-defensives? I say too soon. This is just 1 day worth of activities. And this was initiated by the reports from Micron and Target. Will the market forget about all of that tomorrow? Maybe they'll get a new pulse of pivot optimism. We'll see. But this is why I say don't chase one theme when it happens in a single day. Wait for consistency because you could eat massive pies in the face. The market is moody right now. The market is confused. One day gets a piece of news that says, hey, risk on. The Fed is about to pivot. The economy remains hot and pretty good. The soft landing is here. Another day, we get another piece of information indicating that inflation is going higher and the Fed must act even more aggressively and the pivot optimism goes away. Another day, we get more recession signals. Another reminder that if inflation is indeed cooling down, it is cooling down for the wrong reasons, aka no soft landing. So the market now has to process all of this and come up with a conclusion. You don't want to be standing in the way while the market makes up its mind. Wait for it. And let's move on to the charts analysis here, and we begin with SPY, S&P 500, 30 minutes chart. What do we see here? Yesterday we talked about a bear flag, we talked about a reverse ABC, and today we got a down day, but not a major development yet. All what the chart did is losing the support of 398. That's all there is. Yes, we have negative divergence on the RSI. Yes, this is consolidating yet again in a bearish manner. You can call it a bear flag pattern, which could take us down, let's say to 393.16, even 391. But even if we go down there, even if we go down all the way to 385, is it over? The answer is not really, because what if the aggregate demand kicks in and folks who say, hey, the market went too high too fast, but I'm still interested in buying it because I believe that the Fed is going to pivot. I believe that the soft landing is going to happen, whatever bullshit they're going to believe in. But a break below 385.15 and a close below this number, most importantly, will seal the deal that the bear market rally is over. And here's the continuous contract, the daily chart for the S&P 500, again, consolidating in a bullish manner, bull flag consolidation pattern. Now, if it loses the support of 3,960, then we're talking that perhaps the bull flag pattern is not going to play out. But even if that happens, we still have support all the way down at 3,855. What if that holds and we get a rebound? And then we have what it could be an ABC pattern. So just keep that in mind. I know we have signs of weakness. I know we have signs that this bear market rally is running out of gas. But it remains too premature to make large bets that this bear market rally has ended right now and it's going down. We have no confirmation yet. The volume remains way below average. The momentum indicators remain positive. Wait till you get more signals that this is about to end. Likewise, the Qs, the NASDAQ 30 minutes chart, what's going on here? We got the reverse ABC and now the chart is holding on to the support of 284.25 in or around this number. But it is consolidating in a bear flag manner. We still have negative divergence on the RSI, so we might see the loss of 284 as support and we go down back to 280. But even if that happens, there's nothing that suggests that the bear market rally is ending. You have to look at the indicators. You have to look at what the dollar is doing. Is the dollar moving higher or not? Are yields moving higher or not? Is the VIX moving higher or not? So you have to look for these confirmations before you make a decision that this is over. And here it is, the daily chart for the continuous contract for the NASDAQ. This is consolidating in a bull flag pattern. Still above 11,689. Now if it loses this support, then we're talking. But the volume remains below average. The momentum indicators still positive. But if we get a break below 11,689, and it is a decisive break, we could see the MACD turning negative. And that would be confirmation that yes, we're going back to the June bottom again. The IWM small caps 30 minutes chart, again, here it is. We're getting a bear flag consolidation pattern. With that being said, still no break below 183.25. But if there is a break, we go down all the way to closing the gap at 174.22. And here it is, the Dixie, the dollar index, a daily chart. It appears that we have some signs of bottoming here. For one thing, the flush down candles, the big red candles, they're not happening. It appears that the dollar is finding some footing here. The RSI is oversold and it is curling its way higher again. The MACD indicator is way oversold at this point, so we're due for a bounce in the dollar. Whether that's going to last or not, that's a different story. But a bounce in the dollar will put a pause, not an end, but a pause in the bear market rally. And the confirmation comes from gold. For now, we don't have a confirmation yet. But if gold loses 1,763 as support, and we get a big decisive red candle, then we got a confirmation here. Gold will go down all the way in a retest of the support of 1,685, and the dollar will make decent gains. Whether that's going to last or not, again, that's a different story, but it's going to put a pause to the rally. Here's UK oil, and another warning for oil investors. Look at this, a break below the trend line. So if you're not in oil, wait till we see how it's going to react at 85. If you're in, use the opportunity of selling calls out of the money. Use this money to reduce your entry cost in buying puts. That way, if we have a crash in oil, you're not going to cry, because you already have your insurance policy and you can get out with minimal losses, and in most cases even locking some profits here. What about the 10-year yield? What's going on here? It lost the support of the consolidation pattern, and now we're heading down all the way to 3.5. But today we got signs that perhaps we're not going to go down all the way to 3.5 in one shot. The 10-year is fighting back, and it might reclimb the lower end of the consolidation channel, which used to be support, now resistance. And if it does, if yields move higher, you put 2 and 2 together. Yields moving higher, the Dixie moving higher, and oh, by the way, the VIX might move higher. You got a slam dunk here. The market rally is going to pause. We're going to get a pullback. TLT, look at this, blasting higher. Now at the upper range of the consolidation / resistance zone, and it's doing so in an impulsive manner. This is a combination of short covering in the TLT and panic buying, another recessionary signal. When people panic buying the TLT, they're rushing to safety, the ultimate safety of bonds. Here's the VIX 4 hours chart. What's going on here? It is consolidating at around the resistance of 24.29 in a bull flag manner, at least for now. We know that the MACD indicator is showing positive momentum, but nothing decisive here looking at the 4 hours chart. So let's zoom in to a 30 minutes chart, and we use a line chart this time around. We're now back at 24.29. Some would look at this as a bear flag consolidation pattern, and down we go to the original destination of 20. But the VIX bulls would look at this as, wait a minute here, isn't this a cup and handle formation? If it is, higher we go. Who has the better argument for now? Really hard to say, because we don't have a decisive move by the dollar yet. We don't have a decisive move by gold yet. We don't have a decisive move by the 10-year yield yet. Really hard to say. It could go either way. So why jump on the trade one way or the other? Why assume that the VIX is going to go down or up at this point? Why not wait for the confirmation and then make the move? And here's the 30 minutes chart for Apple. We got a bear flag followed by another bear flag. Of course, getting kicked again from the no entry zone of 150. Apple has to earn the re-entry of 150. A piece of data, earnings, something. But it cannot climb back to 150 with no merit. And now that we have another bear flag consolidation pattern, could this be it that will get us down all the way to 145? That could certainly be the case. Tesla, 30 minutes chart. What's going on here? Look at this. It is melting down, and it lost the trend line. Not a good look for Tesla here. And if this continues, it goes down all the way to the trend line on the daily chart, and that would be a loss of about 6% from this point on. Bitcoin, any update on the 4 hours chart? Not really. Still consolidating in the bearish manner. It needs to break above this consolidation pattern, and I would say all the way to 18,000 before we say, okay, we're out of the woods. And lastly, what do we have on the economic calendar tomorrow? We have initial jobless claims. We also have building permits and housing starts. And the most important, Philly Fed Manufacturing Index. But we also have a bunch of Fed zombies speaking from the Atlanta Fed, the insider trader, Boystick. But most importantly, from the St. Louis Fed, your boy Bullard. High in the sky, baby, 420. But is he? Is he going to flip and move to the dovish side? And if he does, he's going to move the market higher. Because the market is going to say, look, we have consensus here in the Fed that the 50 is going to happen. And then it becomes 25, and then we cut rates. Boom. It's all delusion. It's all a fantasy. They're only going to cut rates if two things happen. A financial accident or a massive recession. If we get one of those reports with millions of people losing jobs, then they're going to cut rates. But now, it's too soon. With that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow.
Your logic is so flawed, son. Hell, it almost makes sense.